operating expenses, or as Adam Newman likes to put it, don't look here. Seriously though, if we look at WeWork's S1, which is the first document a company will file with the SEC prior to going public, WeWork's S1 is problematic for a bunch of reasons, but one pertinent to operating expenses is shown right here. They lumped together all of their expenses and made them intentionally hard to understand, which leads me right into why you should care about operating expenses. To do this, we'll explain operating expenses by beating up WeWork's S1, and then we'll contrast that against the operating expenses of a well-run business. Okay, so normally, just beneath the line on the income statement for gross profit would come a group of expenses called operating expenses. Operating expenses are any expenses that a business incurs through its normal business operations. Some usual examples are rent, equipment, inventory costs, marketing, payroll, insurance, research and development, a sort of catch-all term called selling, general, and administrative. Companies have a lot of latitude on what they can report as an operating expense, which is exactly why I wanted to lead with the WeWork example, to show the type of financial manipulation that can occur. To understand what a company is considering an operating expense, you have to go into the SEC documents, such as the annual reports, quarterly reports, or S1s. I normally do this before I take a position, and as long as nothing seems sketchy and the expenses are consistent quarter to quarter, I don't pay much mind. Consistency quarter to quarter being the operant term. Okay, back to WeWork. As you can see, WeWork had no gross profit to report, so they tried to wallpaper over that by just reporting all of their expenses. They were also trying to sell the street that they were a technology company, and technology companies normally have high gross profit margins. So to keep that fantasy going, they had to muddy the waters as much as legally possible. So if these line items don't make sense, that's the point. Let's turn to how a good business reports expenses. Here's Apple's most recent income statement from their most recent annual report. Full disclosure, a significant portion of my net worth is in Apple stock. Okay, so this is more in line with what we're used to seeing. You have their net sales from products such as the iPhone and iPad, and then services such as iCloud, Apple Fitness, or Apple TV. And then underneath that, you have their cost of sale, which since they have products and services, they call it cost of sales vice cost of goods sold. And then you have their gross margin, which is just under 40%, which is very good for a company that sells hardware. And then you could very clearly see what they consider operating expenses. If you want more information on what Apple considers an operating expense, they clearly declare it and explain why it changed year over year inside the text of the annual report. Contrast that against the flaming pile of that is WeWork's explanation of their operating expenses. It is intentionally confusing, and honestly, I tried finding a clean way to describe it, but I couldn't. Okay, on to the summary of things you should look for. Before taking your initial position in a business, I would read through what they are reporting as operating expenses and make sure that management isn't doing anything sketchy. The easiest way to do this is to just see if you can understand what they're spending money on. If reading through the SEC document puts yourself in a mental pretzel, you can go ahead and assume that there's a red flag. After that, I would want to compare the operating expenses as a percentage of revenue to other companies inside of its industry peer group to get a sense of where the company is relative to its competition. You don't necessarily want the lowest operating expenses relative to its peers because you want management to be investing in the operating functions of the business. This would be like if Coca-Cola stopped advertising, which advertising falls under that selling, general, and administrative line item usually, and SG&A is an operating expense. So if they stopped advertising, sure, there'd be an increase in operating income, but for how many years would we still associate that brown syrup with sweet, sweet Christmas joy? Or if NVIDIA cut back on their research and development operating expense, how long would they remain competitive in the chip space? Chip space. With all that being said, if the operating expenses are highest relative to the industry peers, I would look pretty closely at that and try to square management's justification for the high operating expenses to the direction they plan on taking the company. And then finally, as your maintenance, when you already own the company, I would just make sure that operating expenses are consistent quarter to quarter and year over year. Operating expenses are an important line item to understand, and it's one of the easiest places in all of the financial statements that accountants and management may try to pull the wool over investors' eyes. Don't even get me started on SBC. So as always, stay sharp and do your due diligence. Thanks so much for watching. Please like and subscribe if you found this video helpful.